I want you to write this particular heading in your notebooks. Please write this heading in your notebooks. Tax implication in capital budgeting. Tax implications in capital budgeting. Tax implications in capital budgeting. Please, it will be great if you can maintain silence, because we are really going to learn something important. Please stop all other activities, pay attention and write down these notes. Did you write this heading, tax implications in capital budgeting? Yes, sir. Now, under this heading, you write point number 1. Whenever the company earns profit, comma, it will have to pay tax. Put a full stop and continue in that same point. However, when the company incurs a loss, comma, it will save tax. Because of such loss. Put a full stop. Point number 2. Losses arising in business will lead to tax savings. And that is because income tax law permits set off and carry forward of losses. How do you write set off? SET-OFF. Set off and carry forward of losses. Point number 3. Suppose the company is handling two different projects. That is project A and project B. Put a full stop. In the same point, you please continue. In project A, there is profit of rupees 40 lakhs. In project A, there is a profit of rupees 40 lakhs. Put a full stop and continue in that same point. Tax rate is 30%. Tax rate is 30%. Again, put a full stop and write. Therefore, tax liability arising on profit from project A, tax liability arising on profit from project A will be 40 lakhs into 30%, that equals to rupees 12 lakhs. 40 lakhs into 30%, that equals to rupees 12 lakhs. Put a full stop. How many points you wrote? 3 points. One thing before you proceed ahead, I'm giving these notes in so simple way that without any explanation, whatever you have written by far, I am confident you would have understood. Yes, sir. Am I right? Yes, sir. So, third point begins this way. Let's suppose the company is handling two projects, project A and project B. Project A has generated profit of 40 lakhs and tax rate is 30%. So obviously what is going to happen? Your tax payment will be 30% of 40 lakhs and that is how much? 12 lakhs. This is the third point you have written, right? Now write fourth point. Let us suppose that the company incurred a loss. Let us suppose that the company incurred a loss in project B. The company incurred loss in project B. Put a full stop and write. Such loss is rupees 10 lakhs. Such loss is rupees 10 lakhs. Put a full stop and write. Income tax law permits setting off this loss of rupees 10 lakhs, setting off this loss of rupees 10 lakhs from project B against the profit from project A. Put a full stop and write. As a result, the tax liability of the company, will now be revised to Within brackets write 40 lakhs minus 10 lakhs. 40 lakhs minus 10 lakhs. Close the bracket, and after closing the bracket, write into 30%. 40 lakhs minus 10 lakhs into 30%. That equals to how much? Rupees 9 lakhs. Rupees 9 lakhs. Put a full stop. Fifth point. Because of loss in project B, because of loss in project B, comma, the income tax liability of the company reduced from 12 lakhs to 9 lakhs. Which implies tax savings of rupees 3 lakhs. Put a full stop. And sixth point, the loss in project B, that is rupees 10 lakhs, has resulted into tax savings of 10 lakhs into 30%, 10 lakhs into 30%, that is equal to rupees 3 lakhs. Now tell me one thing. Point number 3 you already understood, right? What did I mention in point number 3? That let us suppose that the company is handling two projects, project A and project B. In project A, there is a profit of rupees 40 lakhs and tax rate is 30%. So obviously on 40 lakhs of profit, how much tax liability the company will be having? 12 lakhs. 40 lakhs into 30%, 12 lakhs. That you have written in point 3. Point 4 brings up a new situation, that where you had profit in project A, you had a loss in project B. What was the amount of that loss? 10 lakhs. So income tax law says that, boss, okay, fine, you are carrying out two business activities. One is project A, one is project B. In one you earned a profit of 40 lakhs. In another one you incurred a loss of 10 lakhs. So your overall profit is how much? 30 lakhs. So you just pay tax on 30 lakhs. You understand this point, right? Yes, you will be learning this in detail in income tax subject. But the point is now very clear that because of this allowance given by income tax law, which allows you to set off this loss of 10 lakhs against the profit of 40 lakhs, and now you will be paying tax only and only on 30 lakhs. So 30% of 30 lakhs becomes your revised tax liability. So your tax liability, which was 12 lakhs, got down to 9 lakhs. It implies tax savings of how much? 3 lakhs. If it implies tax savings of 3 lakhs, why we are able to save tax is the question. It is because of the loss incurred in project B. So how much was the loss incurred in project B? 10 lakhs. 30% of that 10 lakhs is rupees 3 lakhs. So whenever you are setting off a loss against taxable profit, because of that loss, you will be able to save your income tax obligation. Guys, please, once again, confirm one thing before I take you ahead, that point number 4, 5, 6 that you have written, you are crystal clear with that.
Yes, sir.
Now write point number 7. Suppose a company is having a single project. Suppose a company is having single project and in such project a loss arises. Put a comma and write, which could not be set off against any available profit. Which could not be set off against any available profit. Again comma and write, then income tax law allows carry forward of such losses to later years. To later years. Put a full stop and write in the same point. Later on, when the company starts earning profit, later on, when the company starts earning profit, comma, the brought forward losses from past years will be allowed to be set off against the profit earned, and the company will pay tax only on the remainder profit after setting off the brought forward losses. After setting off the brought forward losses. Please read point number 7 for me.
Suppose a company is having a single project and in such project a loss arises which could not be set off against any available profit.
Wait. In this 7th point, what you have just read is, suppose the company has a single project and on that project also what has happened? A loss has arisen. Because there is a single project, you cannot set off that loss against any other available profit. Now read further. Wait. Income tax law in such case will allow you to carry forward those losses. Income tax law says fine, you did not earn profit from this project. It is first of all allowing you that look into other projects if you have earned profit elsewhere, you set off this loss against that profit. You made bad faces. You started crying. Why? Because there is no other project available. So this loss could not be set off. Income tax losses, my child, please don't cry. Please don't cry. If you could not set off this loss against any other profit, we will allow you to set off this loss later on. You can carry forward this loss. And later on when you earn profit, against that profit you set off this loss, and then only on the remainder profit you pay tax. So for example, if the loss that is arising is 10 lakhs, which you could not set off, so don't pay any tax now. You could not save any tax now also, but you carry forward this loss. Next year, you earned 15 lakhs profit, but you don't have to pay tax on 15 lakhs. You first adjust the brought forward loss of 10 lakhs against that 15 lakhs of profit. So your tax liability will now arise at that 30% or 40%, whatever be the tax rate, on the remainder profit after setting off the brought forward losses. That is point number 7. Guys, tell me, are we clear with point number 7?
Yes, sir.
One important advice from my side. One day, when you learn set off and carry forward chapter in income tax, this is a chapter in income tax, you will be coming back to this note and you will read this note once again, correct? So that you get much more clarity after learning the basic things in income tax. But without even this thing covered under income tax for you, what you have learnt right now through these 7 points, are you all clear with that?
Yes, sir.
That's it. Next thing. Before I give you the 8th point, let me discuss one aspect with you. In income tax law, you would observe that there is a particular head of income. Am I getting everyone's attention over here?
Yes, sir.
That's good. In income tax law, you will come across a particular head of income titled as capital gains. It is all about dealing with capital assets. So when you have a capital asset like land, building, machinery, and you are buying that at a particular cost and selling it at some value, so what will happen? That buying and selling, that means the money that you realize, the price that you realize on sale and your adjusted cost of that, if there is a difference between that, that will be also either a gain or a loss. Correct? Either a gain or a loss. So what happens? When you have such gain or loss, that gain or loss is titled as capital gain or capital loss. So, under income tax law, there are 2 typical sections. Section 49 deals with non-depreciable assets and section 50 deals with depreciable assets. You would then learn that capital assets can be classified into 2 categories: long-term capital assets and short-term capital assets. So, gain or loss arising on long-term capital assets is titled as long-term capital gain or long-term capital loss. Gain or loss that arises on short-term capital assets is titled as short-term capital gain or short-term capital loss. As I said, section 49 deals with which assets? Non-depreciable assets. Section 50 deals with depreciable assets. and depreciable assets under income tax law can never be called as long-term capital asset. For example, I have a building. So that building will fall in which category? A building is a depreciable asset, right? Even if that building is there with me past 25 years, it will still be identified as what? Short-term capital asset. Once again, from the beginning, there is one particular head of income under income tax law titled as capital gains that deals with gain or loss arising on capital assets. Gain or loss arising on. So if there is a gain or loss that arises on capital asset, that gain or loss will be known as capital gain or capital loss. Now, how do you distinguish capital gain or loss with your business profit or loss? Simple thing. I am into educational business. Buying a fan and selling a fan is not my business. Buying a camera and selling a camera is not my business. Buying an air conditioner and selling that is not my business. Buying a projector and selling it is not my business. Correct? Buying these recording devices and selling it is not my business. I am into educational business. All these are not my goods. All these are my assets. Correct? If these are my assets, if I buy and sell these assets, this profit is not my business profit. Correct? This kind of profit or loss is termed as capital gain or capital loss, because these are not goods, these are assets, and these assets are known as capital assets. So if the holding period of this capital asset is longer than 3 years, it comes in the category of long-term capital asset, and the resulting gain or loss will be long-term capital gain or long-term capital loss. However, if the holding period is shorter than 3 years, the assets will be classified as short-term capital assets, and the resulting gain or loss will be short-term capital gain or short-term capital loss. However, income tax law clearly makes a distinguishment of two categories of capital asset: non-depreciable assets and depreciable assets. If there is a depreciable asset, it will never come in the category of long-term capital asset, because depreciation is charged every year. There is so much of talking coming from that side. Depreciation is charged every year, and as a result, the base of the block changes every year, and that is why this kind of depreciable asset, as per income tax law, will never come in the category of long-term capital asset. So the capital gain or capital loss that arises on depreciable assets will always be classified as short-term capital gain or short-term capital loss. So how do you compute this kind of loss? You purchased a machinery, suppose. You kept on charging depreciation year 1, year 2, year 3. The value of the machine starts reducing. One point of time, there will be a WDV of machine. And suppose that day you sell that machine for something more than its WDV. I'm not saying more than the cost, more than the WDV. So if WDV of the machine is 5 lakhs, you sold it for 6 lakhs. The resulting gain will be short-term capital gain. Correct? But if there is a machinery which has WDV of 5 lakhs, you sold it for 4 lakhs, there will be a short-term capital loss. However, there is one more thing that will come into picture, that is the concept of block of assets. That is also income tax concept. Everything that I am discussing right now under this heading tax implications, these are not financial management concepts. These are income tax concepts. So block of asset concepts will come into picture, and that time dealing with capital gain or loss on depreciable asset, you will have to be more cautious, because gain or loss will not arise unless the block becomes empty. Once the block becomes empty, then only capital gain or loss arises. If block doesn't become empty, it is just the depreciation base that will change. So what I'll do is, a little later, I'm going to introduce the concept of block of assets. Not right now. Otherwise, what will happen? Too many things mixed up, you will be getting confused. So, what you do is, 8th point, let us continue. 8th point. Under income tax law, there is a specific head for gain or loss arising on capital assets. Gain or loss arising on capital assets. Put a full stop and write, such head of income is titled as capital gains. Point number 9. Under the head capital gains, comma, all depreciable assets are necessarily treated as short-term capital assets. Put a full stop and continue in that same point. Therefore, gain or loss arising on depreciable assets, will always be treated as short-term capital gain or short-term capital loss. Short-term capital gain or short-term capital loss. Tenth point. On depreciable assets, the difference between on depreciable assets, the difference between the sale value of the asset and the WDV of asset will be the resulting gain or loss when the asset is sold. When the asset is sold. Put a full stop and within brackets write subject to application of block of asset concept. Subject to application of block of asset concept. You wrote that within brackets, right? Subject to application of block of asset concept. Put a dash and write TBDL. T for Tamil Nadu. B for Bombay. D for Delhi. L for London. TBDL means what? To be discussed later. So, close the bracket now. How many points did you write? In total 10 points. How many we have already discussed and understood clearly? In fact, with those 7 points, I made you write the notes first and then I have explained. With respect to point number 8, 9, 10, I already explained first and then gave you notes. When you sell a capital asset, the WDV of that asset will be compared with what? Sale value of the asset. The difference between these two will be treated as capital gain or capital loss. That is short-term capital gain or short-term capital loss. But when? Not every year. Only when the asset is sold. See, gain or loss won't arise until the asset is sold. But subject to which concept? Block of asset concept. Once I take you to block of asset concept, that time I'll explain in detail what is this block of asset concept and I'll give you specific notes over there as well. I believe right now, when you have learned these 10 points, you are ready to apply these 10 points. And in one of the questions in my book, which is a brilliant, very, very important question, I have covered aspects of all these 10 points in that one question. And that beautiful question is question number 27.